January data dump is not just numbers on a page, it can move prices at the grocery store and in energy markets. As traders wake to USDA updates, global weather chatter and shifting biofuel mandates collide with supply realities. A sudden 20-cent move in corn prices might ripple through futures margins, ethanol margins, and livestock feed costs for millions of farmers and processors. In plain terms, this is a weather and policy-fueled snapshot that can tilt budgets for processors like Archer Daniels Midland and Cargill and test confidence in risk models across asset classes. Global supply chains remain delicate under evolving tariffs. What is happening is simpler to describe than the market reaction implies. The January data dump from USDA and other agencies is expected to update planted acreage, weather-affected yields, and stocks to usage. Traders scan for surprises, the degree of yield in key growing regions, and whether demand trends like ethanol blends or protein usage have shifted. The price swing target, around 20 cents, reflects a crowd trying to price in uncertain harvest conditions, plus policy signals from crop insurance subsidies and biofuel mandates. In short, the market is passing fresh numbers for a future that remains highly weather-sensitive. Background here means history and memory as much as numbers. Corn markets were carved by droughts into 2012 highs and by bumper yields that collapsed prices in 2014. Since then, traders watch the USDA pace of planting and the pace of harvest from regions like Iowa, Illinois, and Nebraska, just as bankers watch interest rate paths. The January report is a milestone because it often reframes how much farmers plant next season and how much processors need to hedge. The data interacts with futures curves shaped by storage costs and the risk premium traders demand when weather risks are uncertain. Current market impact shows up in futures boards and cash markets across the Midwest. When traders expect a big January move, volume often doubles as spreads widen between front-month and second-month contracts. Cash prices in local elevators swing with sentiment and with export talk from buyers worried about late-planted acres and potential quality issues. Airlines and ethanol plants hedge inputs to lock in costs, while feedlots watch feed costs as a percentage of overall expenses. The chaos scenario may ignite volatility, but also invite risk management tactics that reward disciplined hedging and diversified portfolios across global markets. Who is affected includes farmers facing higher inputs and uncertain yields, grain merchandisers, and big processors who hedge aggressively. Elevator operators in Iowa and Nebraska can see price signals ripple through storage and capacity constraints. End users like poultry and pork producers rely on predictable corn prices and margins, while ethanol producers may gain or lose depending on feedstock costs. Bank risk managers and funds that run commodity equity sleeves adjust positions to maintain liquidity. Retail investors become exposed through farm-related equities and exchange-traded products that track corn or agriculture baskets. Small farms may feel squeezed first today. Geopolitics and macro factors frame the backdrop regardless of the grain itself. A global economy sketched by inflation rates and central bank paths influences hedging costs and risk appetites. Trade tensions or sanctions can tilt feed ingredient imports, while currency moves alter domestic price competitiveness. In addition, drought risk in major exporting regions or frost in key hubs can tighten or relax supply expectations. Climate policy and energy demand shape ethanol consumption, which in turn guides corn usage. The January data dump arrives amid a chaotic mix of headlines that can magnify small surprises into bigger market moves for traders. Smart money reacts with disciplined hedges and selective positioning. Funds may rotate into commodity equities that show leverage to fertilizer and energy margins, while non-farm commodity funds add to short-duration grains if volatility spikes. Banks and prop desks calibrate models to a wider skew for January weather surprises and adjust risk budgets accordingly. Some retailers and smaller traders shift to option structures that cap risk while maintaining upside exposure. The most credible signals come from multiple legs of the market, aligning futures spreads with cash bids, and from open interest moving with credible volume. Momentum builds across correlated assets. Bear case reasons include a bigger-than-expected January surplus if weather cooperates, allowing prices to crater. Another risk is a delayed harvest of quality grades that complicates storage and raises basis volatility. Political shifts or unexpected policy changes could curb demand for ethanol or increase tariffs on exports, depressing corn flows. Liquidity droughts in extreme volatility periods may trigger forced selling and margin calls. Global demand could pivot to substitutes or alternate energy inputs. Investors should prepare for technical breakouts or breakdowns that trap late entrants in crowded trades. This requires robust stop losses and diversified risk management today. Retail investors can respond by anchoring decisions to plan, not panic. Start with a clear budget and a defined risk cap before touching futures or options. Consider simple hedges like buying puts on a modest portion of corn exposure or using broad agriculture ETFs to gain diversified exposure without timing the exact USDA release. Track expectations versus actuals and avoid chasing late moves. Use limit orders and staggered entry points. Leverage educational resources and track credible data releases. Remember that information asymmetry grows during data dumps. Choose patience over impulsive bets. Consistency over excitement helps long-run returns for beginners. Outlook suggests January data will not settle the market, but sharpen it. If the forecast for heat and drought accuracy tilts bullish, the 20-cent swing could extend. If yields surprise to the downside, the drop could deepen. Analysts expect continued volatility as traders reprice risk into hedges with time horizons. Real assets like farm equipment shares or storage capacity may benefit from more cautious but persistent demand. Regardless, the message is clear. Monitor USDA releases and macro signals, diversify your exposure, and prepare for non-linear moves. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.